This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, July the 26th, 2015. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you will not be able to see some of the detail I will be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates developments in macroeconomics. Therefore, the slides this morning will focus on our other three report areas of the GMTP report: global risk, and regional and U.S. economic developments. As I often do, I'd like to tie them together into a discussion on the global emerging markets and a concept I've written about before, which I refer to as the echo boom. In this regard, I'd like to discuss the following points here this morning: the globalization trap thesis paper, and specifically the element in it I discussed then of the echo boom, what the key points of it were, and what to watch for. Secondly, developments that are happening in the commodity supercycle, which I believe has been ending for about 18 months now. Third, the echo boom and where we stand right now as its cascading and reverberations around the globe occur. And most importantly, what I see to expect going forward. There are a number of areas that I think will fall very quickly from these current developments, both in Central and Eastern Europe, that will affect the banking industry within the EU, the approaching the ASEAN common market in Asia, and of course the fallout from this continuing strong dollar as regards earnings and the S&P 500, the growth engine around the world, being the United States economy. In the fall of 2013, I wrote the thesis paper, The Globalization Trap. I argued a number of ideas in the paper, which are particularly important as we witness the August carnage in the global markets, and I felt needed to be revisited at this point in time. First, I said that the credit acceleration in central bank liquidity growth would lead to a crack-up boom, a boom that would come in phases, as I'll show here in the next chart. Number two, the resulting asset appreciation would eventually lead to real deflation and then collateral impairment. Three, that the cheap money and credit being created would distort global markets and foster an echo boom in the emerging markets as a direct consequence of an overbuild out in capacity. Four, the emerging markets would be a precursor to what I refer to as real deflation. Five, this real deflation would force more central banks into further obscene experimental policies such as collateral guarantees, which in turn would ignite hyperinflation due to collapsing currency values. And six, in the final stages, the US dollar would be the last to be hit by a lack of confidence, and the global economies would then see a global fiat currency collapse, or more likely, a massive global revaluation under distressed conditions. We have been in the real deflation period for some time now, marked by DR in this chart. Until recently, we haven't seen it in the US equity markets, but it has been very evident in many of the other markets for quite some time now. With the collapse in commodities, destruction of oil prices, and a falling trade volume, it has been devastating to the emerging markets and economies and has triggered the echo boom. The trigger was actually the announcement by the US of taper, or the ending of quantitative easing, as I'll show later. We are now on the bottom side of this echo boom chart, which was taken from the globalization trap. We can see here we expect problems in the Central and European countries to be next, as well as increasing problems at the state, city, and local level within the United States. That is, problems starting at the bottom and working themselves up regarding debt and the ability to service the entitlement programs. The resulting policy responses here will eventually lead to hyperinflation and that last leg up in the US equity markets shown on the last slide. In May of 2008, during the financial crisis, I wrote a number of articles arguing we had the initial stages of a breakdown in the Asian mercantilism model. I argued, and I quote from the abstract on a series I wrote on the coming currency wars. In May, I wrote, for nearly 30 years, we have had two global strategies working in symbiotic fashion that has created a virtuous economic growth spiral. Unfortunately, the economic underpinnings were flawed, and as a consequence, the virtuous cycle has ended. It is now in the process of reversing and becoming a vicious downward economic spiral. One of the strategies is the Asian mercantile strategy. The other is the US dollar reserve strategy. These two strategies have worked in harmony because they fed off each other, each reinforcing the other. However, today, the realities of debt saturation have brought this virtuous spiral to an end. I also wrote that in regards to the EU, which subsequently became a crisis, in an article called A Flawed Foundation but a Brilliant Strategy, and I quote from the abstract, it was the perception of getting something of value without any meaningful sacrifice that initially fostered the EU monetary union. Though the countries of Europe were fiercely nationalistic, they were willing to surrender minor sovereign powers only if it was going to prove advantageous to them. They were certainly unwilling to relinquish sufficient sovereignty to create the requisite political union required for its success. After a decade-long trial period, it is now time to pay the price for the failed monetary union. I suspect that EU membership is unwilling to do so, though they likely will see the price as too high to do so. The price to not do so has become even greater. They have unwittingly been trapped by a well-crafted strategy. And in both cases that I wrote this in, as I said, in these articles in 2011, they have developed and increased and accelerated. Since I wrote these papers, we had the advent of ZIRP, multiple quantitative easing version, and Operation Twist. What they did was keep the global economy alive by fostering the growth of debt almost solely for consumption. Consumption which was required to keep the US engine of growth alive, an economy which was already running at an unsustainable level of 70% consumption. The cheap money marginally increased demand by bringing demand forward. What is not often appreciated is that cheap money resulted in massive overbuilding of capacity. Evidence can be seen in China's sustained expansion, but more importantly, in the explosion in commodities and resources from the emerging markets. At some point, they come into balance, that is, supply and demand, and quantitative easing will no longer work. It can no longer bring more demand forward. By continuing quantitative easing, capacity, that is, the supply, only continues to increase as competition heats up and pricing power is lost. This is what triggers the real deflation. All of this was perfectly predictable from the discussions we had during this period on the policies of monetary malpractice, which were fostering moral hazard and unintended consequences, leading to the mispricing of risk, lack of price discovery, and the malinvestment on a monumental scale. Malinvestments in the form of capacity based on expectation levels of artificial demand. This is something right out of a macroeconomics 101 course taught to any freshman college student. What actually brings this to a head is that the falling prices in commodities places the export-led mercantilism business model of which is held by most of the emerging markets in jeopardy. They potentially can't pay their debt because of their falling current accounts. But there is something else even more dangerous. Cheap money from the US's cheap money policy resulted in $9 trillion being borrowed by emerging markets in US dollars. The idea of a carry trade is to borrow in a currency that will depreciate so you can pay the loan or carry back in cheap dollars. Not to do that is the cardinal sin. Unfortunately, this is not what has happened as the US dollar has skyrocketed upward and the emerging market borrowers have been caught on the wrong side of the carry trade. The problems are getting worse as trade continues to fall as well as oil prices falling. As I said earlier, this was to be expected and has been evident since the US taper program was announced by the US Federal Reserve. It didn't just coincide with the beginning collapse in commodities, but the rising value of the US dollar. They are inextricably tied as most commodities are priced and traded in US dollars. The commodities index is now trading at the lowest level since 1999, just prior to the implosion of the dot-com bubble. Yet another bubble based on false expectations for free cash flow growth that would generate real wealth. Not necessarily excess supply, just excess expectations of what would happen. During the current period, there has been a complete inability of monetary policy to generate inflation. Inflation needed to keep real rates negative to maintain government debt payments. I'm not proposing inflation is a good idea, but this has been the central core and premise of monetary policy to make this happen, and it has failed. In other words, we have real deflation. A lack of inflation is added to the strength of the US dollar on a relative basis as it effectively exported inflation and imported deflation. Over the past 2 weeks, the media has spent quite a bit of time documenting the veritable collapse in the emerging market stocks, bonds, and foreign exchange in the wake of China's move to devalue the yuan. The yuan devaluation effectively telegraphed Beijing's concerns about the economy, confirming fears that the situation was worse than they were saying or willing to admit, and putting further pressure on commodity prices, which are now sitting, as I showed, at their lowest levels of the 21st century. Now, with emerging markets in turmoil from Brazil to Malaysia, Bloomberg is out with this chart, our map, which sums up the carnage by showing just how many emerging markets are in or closing in on bear market territory, as we predicted. The currencies of emerging markets continue to fall. It isn't just the US dollars going up, they're going up in relationship to falling markets, which are falling in emerging markets foreign exchange. We have seen this before. The mercantilist export-led Asian economies. This has happened a number of times before in Asia in a slightly different manner. And I quote from Zero Hedge, the devaluation of the yuan risks a new round of competitive easing that may send the currencies from Brazil's real to Indonesia's rupee tumbling by an average of 30 to 50% in the next 9 months, according to investor and former International Monetary Fund economist Stephen Yen. End of quote. Given the carnage unfolding across emerging market currencies and the myriad headwinds the world's emerging economies face going forward, it should come as no surprise that sentiment has turned decisively negative, compounding the problem. Is it time to be contrarian? Both the Bank of America and Morgan Stanley now say so. Everybody's climbing on this bandwagon. As an example, Bloomberg reports that Brazil, let's talk about Latin America here for a moment, that Brazil is now looking down the barrel of another likely event, a junk rating of its government bonds. Things are cascading. And I quote, Latin America's largest economy has a 70% chance of losing its investment grade rating in the next few years, according to the median estimate in Bloomberg's new survey of economists. End of quote. Standard & Poor's said last week it may downgrade the country, that is Brazil's, rating and revised its outlook to negative from stable. Brazil's bonds are currently rated BBB minus, which is one step away from junk. Obviously, no one believes these official estimates for inflation going forward. Is it any wonder? Look at this pattern of Latin America since 2010. The pattern is evident throughout. It's a steady decline. It's a secular problem we're facing. And it was indicative of this in 2008 when I wrote the papers I referred to earlier and the globalization trap thesis paper. So what do we expect? I believe that the Central and Eastern Europe areas will soon be a major emerging market problem, getting little press or little visibility today. which will seriously impact the already unstable EU banking system. We have a crisis today coming out of China. Wait till this one happens. And it's only a matter of time when you look at the current accounts here. And especially with loans in Central and Eastern Europe being taken out in EU dollars and local currencies falling and economies slowing dramatically. Same problem as seen in all emerging markets. We also believe the February launch of the ASEAN Common Market will be a major problem for China and Japan regarding productivity. The problem in the emerging markets can be expected to get worse, potentially much worse. According to JP Morgan, Asia today has a number of similarities with the 1990s cycle in terms of misallocation led by a low real rate environment and then an adjustment cycle triggered by reversal in the US monetary policy. They specifically cite one, a low real rates environment aided by a starting point of high excess savings and easy monetary policy in the US. Two, domestic misallocation in both cycles. There has been trailing misallocation of resources into unproductive areas. This is best seen in the rise of the region's ICOR in both cycles. Three, debt buildup. Since 2008, the region's debt to GDP has risen by 52 basis points to 206% in 2014. Similarly, in the 1990s, there had been a buildup of debt in the run-up to the Asian financial crisis. And four, external triggers, that is the adjustment phase in both cycles, has been triggered by the rise in U.S. real rates and appreciation of the U.S. dollar, though in this cycle, the slowdown in China has been an additional factor in driving the adjustment. But the final key commonality between the Asian crisis and now is the transmission through falling commodity prices and its aftershocks for the emerging market commodity producers, especially those pegged with exchange rates, and a negative trade shock. Where does the engine of global growth stand? That is the U.S. We believe the U.S. is on the verge of an earnings recession because so much of the S&P earnings are now international and out of these emerging markets and China. Slowing revenues and rising U.S. dollar are a bad elixir for earnings growth multiples. So, in summary, let me remind you, in spite of all of these problems and what's going on here, the central banks and the government will do what they've always done. They will print money. But until no one trusts that money, things will expand. So we may have, and we will have, serious volatility and panic, as I've been calling for in the MATA document for quite some time, short term. There will be policies that will shock you that are yet to come that likely will lead to one more major lift in the markets, though it's false, and ending badly, probably sometime in 2016. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a very knowledgeable and well-informed financial advisor. So until we talk again, may 2015 turn out to be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.